So maybe my last piece of advice will be don't take your tax advice from TikTok, or you know, bring it to your tax preparer, sure, but do not just take it as truth. Talk to an actual professional. A lot of the TikTokers who give tax advice are not actually licensed professionals, and so you should be really careful about following their potentially scammy advice. You didn't start your practice to barely hang on. I'll guess you started it for freedom, impact, and profit. This is Therapy for Your Money. I'm your host, Julie Harris. I'm an accountant, author of Profit First for Therapists, and CEO of GreenOak Accounting. Over the years, my team and I have partnered with hundreds of private practice owners, whether they're just getting started, scaling into thriving groups, or even preparing to sell. We've seen it all, and we know exactly what makes a practice tick financially. On Therapy for Your Money, I'll help you build a business that truly works for you. You'll get quick, actionable tips and episodes so that you can grow a profitable practice, increase your financial confidence, and pay yourself unapologetically. Because your work is way too important for you to burn out or go broke doing it. Love the podcast? Make sure to follow and give us a 5-star review. Here is Therapy for Your Money. Hello, everyone, and welcome back to Therapy for Your Money. Today, we have a special tax episode where we are talking about business and personal tax credit that small business owners may qualify for. So we want to give you some details on that. So joining me today, we have Adam Rook from the incredible tax team at GreenOak Accounting. Adam, welcome to the podcast.
Thank you. Good to be here.
Yeah. So, okay, let's just jump right in. We are talking about tax credits. Please run us through the difference between a tax credit and a tax deduction. How are those different?
The main difference I would say between credits and deductions are that deductions reduce your taxable income, but credits actually reduce the amount of tax that you owe. So if you only had one to choose from, you should pretty much always choose the credit. However, credits have more rules than deductions do. So that's just something else you have to keep in mind. But yeah, overall, credits are always pretty much always better than deduction is.
Yeah. So as an example, if you were spending $100 on a tax deduction, that would reduce your taxable income. So it would reduce it by your tax bracket, right? So you might save 22% in tax, right? Or $22. However, a $100 tax credit means you reduce your tax bill by $100.
But yeah, so you save, multiple times more with the
Yeah.
credit than a deduction.
Way, way, way more. And there's way less credits, right? That's why, because they're so generous. Okay. So let's talk about some of the credits that are likely going to apply to private practice owners. We'll start there. So we'll go over those. Then we will go over some credits that may apply in certain fringe cases, but are less likely to apply in private practice. So what are some of the top credits that apply for our practice owner listeners?
One of the big ones that we saw last year was the retirement credit. And that one is a business credit, and
Okay.
it's something you can get when you have a retirement plan that you offer to your employees and you started it within the last 5 years. So yeah, there's quite a few expenses there that qualify for the credit, and it can really add up. So yeah, if you're putting money into a retirement plan for your employees, this is definitely one that you could qualify for.
Okay. So what do you need to do to get the credit?
Yeah, so basically, you would need to be paying for things like setup costs or administrative fees or employer contributions into your employees' retirement accounts. And if you're doing any of those things, then you could potentially get a credit. And the more of those things you do, the more of a credit you could get.
So what is the cap on the credit then?
It's actually something that it doesn't really have a cap.
Even
At
better.
least some of it doesn't. If you have a lot of employees that you're contributing money into their retirement plan, then you could get up to $1,000 per employee. So there's no limit there. But the setup costs and administrative costs, those can have some limitations. But yeah, overall, that it really depends on just how much you you have, that you're contributing into your employees' retirement accounts.
So you can get a credit for the first year and the next 4 years of the plan. Is that correct?
Yes, yes, for the employer contributions. Yep, you can do that for the first 5 years and get a credit there.
Amazing. All right. What are some of the other credits that may apply for small business owners?
So there's another one called the dependent care credit. And this one's a personal tax credit that you can get when you provide childcare services, or sorry, that when you pay for childcare services for a dependent or someone who can't care for themselves. It's basically something you could pay like an organization or an individual, and just you basically just put how much you paid them on your tax return, and then the name of the organization as well as their, like ID, taxpayer ID number, social security number, that kind of thing.
Yeah. And what are there any restrictions for this credit?
So if it's a child of yours, then the child would need to be under 13 years old, and then also that child would need to live with you for at least half of the year. And so that's definitely the most common situation we see where, there's a working parent or working parents, and they pay for childcare for, part of the year, and then they get that part of that money credited back to them with this credit.
Okay. And do both parents need to be working for this credit to apply?
Both parents need to be working or looking for work. That is a requirement.
Okay. So working or actively looking for work. Okay. Tell us about the next credit that you have for us.
The next credit, as you're alluding to, is the tuition credit. So that one is also a personal tax credit, and it is something you can get for yourself or your spouse or a dependent. And it includes any costs that you pay for tuition or books or other fees for any college or university. And basically, the way you would get that credit is you would just get a form from the college called a tuition statement. And that would have all the information that you would need to put on the personal tax return to get that credit.
Okay. So all you need to do then is like get the form, make sure you have the form, and then are there any restrictions to this?
Yeah, there are. So there's basically some age restrictions for a dependent. Once they turn a certain age, you can't get this credit anymore. I believe that's 24. And then also, we've seen a lot of people not get this credit because their income is pretty high. So if your income's over a certain amount, you also wouldn't get this credit. But if as long as you meet those kind of more basic requirements, then you should be okay there.
Okay. And are there limits to the amount of the credit?
Yeah, yeah. So there's actually a couple different credits. One is $2,500 per person, and then there's another one that's $2,000, but that's for the whole year, tax year. So if you have multiple people going to college
Okay.
using this other credit, then you can only get $2,000 with that other one. But yeah, so those are the limitations there.
Okay. Got it. Any other credits for us?
Yeah, yeah. There's one more that's been fairly common that we've seen is called the energy efficient tax credit. And this one is actually a business and a personal tax credit. And it just depends on what you use this product, the energy efficient product for, if it was for your business or your personal home. And basically it's something you can get up to 30% of the costs reimbursed to you from the IRS. The only thing with this one is that it expired at the end of 2025. So yeah, if you didn't buy something before the end of last year, then this credit wouldn't be able to be used.
Okay. So what are some of the things that maybe business owners or just even like bought for the business or in their personal lives that could qualify for this? Like what types of things would qualify for this credit?
Yeah, so some of the more common ones that we've seen are solar panels, HVAC systems that are energy efficient, doors, windows. There's quite a few different things that that could work. So yeah, that you can just try to get the paperwork from the place you get the energy efficient product from and provide that to your preparer.
Got it. Okay. So there would be like on the receipt, it would show that it was an energy efficient appliance.
Exactly. Yeah.
Okay. I feel like this is probably an area where you often get maybe pushback from people who say like, "Oh, I don't have the receipt. I can't find it." Right? Like, is that am I right or am I off base?
No, you're right. Yeah. A lot of people, they may not think like, oh, you mean my, appliance that I bought for $1,000 counts? Oh, okay. I don't know where my receipt is, so yeah, we have issues there sometimes, but that's why it's always good to hang on to receipts, even if they're for your home, personal home, because you never know, if you could potentially get a credit for it.
Yeah. Yeah, definitely if you're doing things with to your home or to like a building that you own, do keep those receipts. It's surprising how often business owners don't have receipts, but you should be keeping those. When you later on sell a home, it's helpful to have receipts for a lot of the improvements that you've made also. Like if you don't have a record of it, it's hard to estimate. Let's move on. I know you have a list of a couple of credits that are less likely to apply. And so, as I mentioned earlier, Adam, you're on our tax team. We do hundreds of returns every single year at GreenOak. And so these are credits that you actually didn't find none of our clients qualified for them, but there may be someone out there that might qualify and could use it. So we just did want to just give them a honorable mention, right?
Yeah, we do get some inquiries about these ones, so yeah, we go ahead and
Yeah,
just mention the
hit
first
me
one
with it.
here. So the first one is the R&D credit that we hear some clients ask about. So this one's been around for a while. It's basically any research expenses that are qualified under the IRS rules can potentially receive a credit. So it would involve just trying to research a new process or a new product or something like that. And yeah, unfortunately, in the mental health industry, it's not something that is very common
Yeah.
because yeah, a lot of people don't have the time or want to put the effort into researching something innovative. So
Yeah. I want to mention R&D stands for research and development. So this is very, very commonly used in software companies and technology companies because they have entire teams doing research and development, right? Pharma probably uses this pretty extensively. Um, but in the context of a private practice, it doesn't really apply. Like we were talking before recording. I know we've had clients ask like, "Oh, well, I go to my own therapy. Could that be research and development?" And really, it is not. It is a personal healthcare expense, but it is not considered research and development, right? So we were talking about if you were creating a new app for your clients to use, like that might be considered R&D, right? But something of that nature, not just like an expense that happens here and there, right?
exactly, yeah, that's exactly right.
Okay. What are some of the other credits that are out there, but that may not apply here?
Yeah, so another one is the commercial clean vehicle credit. And this one is relating to electric vehicles that people buy and could get a credit for. So this one has a fair number of requirements as well. And unfortunately, it did also expire last year on September 30th. So that's another one that if you didn't get it before then there's no credit available. But it is something that you could still provide the paperwork for if from your dealer if you bought one before that date, and the preparer could see if you qualify. But yeah, like you said, we didn't really have anyone that qualified for that
Yeah.
when we were doing our taxes last year.
Okay. What other credits are there out there?
Yeah, so there are a couple other ones we thought were worth mentioning. Was one is the employer provided childcare credit. And that one is it's a business credit as well. And it's basically where business provides childcare services or some sort of resources for their employees. So it could be you want to add a childcare facility to your building, or you pay for some workers to help watch your employees' kids, something like that. Those would be able to be credited, at least a portion of them. But again, it's not something we really see just because it's a lot of extra investment and
Yeah.
yeah, so yeah, it's not, yeah, we haven't really seen that one.
Yeah. Like it's a great credit, but it also costs a lot of money to set something like this up. So there's still a significant expense, right? And it just typically doesn't make sense in a private practice. Yeah. Any other credits you want to mention?
Yeah, yeah, just one more. The work opportunity tax credit is one that we've also heard a few times from our clients. And this one is basically where you hire employees that have had issues with getting work in the past. It could be like an ex-felon or a veteran or someone who receives federal aid. And so there's a fairly large group of people that could, qualify, but yeah, it's just not a lot of, not something we see much that group practice owners typically want to take advantage of, but it's still there. And so it's an option, but it's not very common.
Yeah. And it's a little bit harder to know, right? Like typically that you are, um, how would you know that someone qualifies for this, Adam? Like you would be recruiting in a very specific way, right? To know that you would be able to use this credit.
Yeah, yeah, you would need to probably, reach out to a place like the VA or social services agency or something like that to find people, and then you also need to have them fill out some paperwork to make sure they qualify. So yeah, it can be a little tricky finding the right people for this one.
Well, thank you for that overview of credits, Adam. Since I know most of our listeners are still in the throes of tax season, and by the time this airs, you will be as well. Are there any is there anything you want our listeners to know about tax deductions?
Yeah, yeah. So keep receipts for those, I would say, is a big one, and then just remember that the IRS is could audit you, and so they're wanting to make sure the expenses are appropriate for your business, and so if it's uh, you know personal in nature, then it's not going to be allowed. But if it's something that's normal that business owners get and it's useful, then chances are you'll be totally fine to take that deduction.
Yeah. And the IRS's official term is ordinary and necessary, right? Which is not always that clear to business owners. Like, what exactly does that mean? But a way I like to think about it is it doesn't have to be indispensable, right? Like you could run a practice without ever paying for Google Ads. You could do that, but using Google Ads is normal for a private practice, and it usually is going to help increase your revenue overall, right? So it is kind of a normal part of the course. It is commonly accepted, and it generally will mean you will end up with more taxable income, which benefits everyone, right? Including the IRS. So like just because you could do without doesn't mean it's not deductible. It just has to be kind of normal. Like you would not necessarily need to own a hot air balloon as a practice. That would not be a ordinary and necessary form of advertising. So like that probably wouldn't qualify, although someone probably has tried out there. But right there are some that are a little clearer than others, but most normal business expenses are deductible.
Yeah, yeah, absolutely. And you can always ask your tax preparer if you're not sure, and then they should be able to tell you. But yeah, I mean, if you think it's probably going to work, then it probably will.
Yeah. Okay, so speaking of that, then Adam, speaking of asking your tax preparer, I'm gonna get on my little soapbox for a second, and remind our listeners that my opinion is that business owners should not be preparing their own tax returns. If you have a business, you have a more complex tax situation, you don't know what you don't know, you need to be working with a professional because there are so many ways that you can mess things up. If you work for someone else as a W-2, you can knock yourself out with TurboTax. You have my blessing. Adam, do they have your blessing as well?
Oh, yes.
Yeah, knock yourself out. But if you have a business, you need to work with a professional. Do you have off the top of your head like a crazy thing that went wrong? Like we fix so many tax problems throughout the year. What is one of the things that's kind of popping to your head, like that a problem that could have been completely avoidable?
Yeah, yeah. I know one where there was an EIN issue where someone just got another EIN accidentally, and not accidentally, by the advice of her accountant, and then just threw everything off for a few years, and we had to work with the IRS to get it resolved. And so yeah, that one was hard for us to figure out. But so yeah, if yeah, there's a lot of different situations we run into, but some of them just yeah, it can get really bad with back taxes and IRS issues, and so yeah.
Yeah, it can get very wonky. One of the craziest I've ever seen is a client who came to us who said they had an S corp, and when we asked for their prior year tax return, they just gave us like a K-1 that was handwritten that they had mailed to the IRS. Like, well, where's the rest of the tax return? He said, well, this is it. I filled this out and I sent it to the IRS. And so as you can imagine, what the IRS had on record is that no return was filed, right? And unfortunately, the answer, like, I didn't know, the IRS does not care. They don't care that you didn't know. You should, they consider that you should have known as a business owner. It's your responsibility to get the information that you need. And so there were thousands of dollars in penalties for what could have been 100% avoidable by just filing the right form with the tax preparer. And so, yeah, now we file the tax return, of course, because we know what to file. All right, we're going to wrap this episode up, Adam. Thank you so much for being here. Do you have one last piece of advice for our listeners before we go?
Yeah. So yeah, everyone's situation is unique. So if you think you qualify for one of these credits, yeah, definitely again reach out to your preparer, or you can look at the IRS website. They have a lot of good resources, and they can tell you what's an actual credit, what's a scam, and
Mm.
so that way you can kind of just tell like, hey, that what I'm being told on the internet isn't accurate. I need to make sure I do check with someone else that knows what this kind of information first.
So maybe my last piece of advice will be don't take your tax advice from TikTok, or you know, bring it to your tax preparer, sure, but do not just take it as truth. Talk to an actual professional. A lot of the TikTokers who give tax advice are not actually licensed professionals, and so you should be really careful about following their potentially scammy advice.
Yes.
All right. Thanks, Adam, so much for coming on the podcast. This was your first appearance on Therapy for Your Money, and I hope we'll have you again many, many times.
Thank you, Julie.
That's it for today's episode of Therapy for Your Money. Catch us on Instagram and Facebook at Therapy for Your Money Podcast, and don't forget to subscribe to GreenOak Accounting on YouTube. Until next time.
The information contained in this podcast represents the host and guest's general opinions and should not be construed as personalized accounting and tax advice. Listeners should consider all facts and circumstances before applying this information and seek appropriate advice from an accountant, financial planner, lawyer, or other professional. Any info provided does not constitute accounting, tax, or legal advice.